Hey everyone, Couch Investor back to another video for today and with the first SoFi video of 2023. So as the thumbnail says, SoFi profit? A bit strange. Well, I thought so as well. But if we play around with the numbers, then actually, yes, the business itself is profitable. How? We're going to have a look at that. In this video, we're going to have a look at some analyst price target changes as well, the current state of the company, and then talk a bit about their full year guidance and how that might actually change now that, well, the Students' Loan Act, the moratorium, has been extended until June 2023. So if you're interested in all of that, sit back and relax, hit that thumbs up button. I would really appreciate that. Subscribe if you have not. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor. So as always, first things first, let's have a look at the current state of SoFi. So of course, revenue growth has been quite nice in the last couple of years, even without that loan part of the business, right? So it's a, let's say, short-term, a bit more long-term than expected, but it's a short-term headwind that will turn into a tailwind. Now, when we look at free cash flow, the story there is not very nice, right? Free cash flow positive by a lot, $6.1 billion in the last 12 months, not great. Return on equity has been going up a little bit, but then again, it's still negative, minus 7%. Gross profit margin, good there, 77.7%. Then from a price to sales ratio aspect right now, for the next 12 months, we're at just over 2 times. Now with a market cap of $4.29 billion, total return the last year, it's down 66%. Let's have a look at what analysts are saying. So right now we have 13 analysts covering the stock, which is way more than a year or so ago. As you can see, the average price target has come down. Well, and the same can be said about the stock price of SoFi. Now, right now, the average price target sits at $7.79, which means the difference between the stock price right now and the price target is close to 69%. Nice. Now, of course, with price targets, they change over time. As you can clearly see on the graph right here, if suddenly the stock goes higher, but the company just continues to execute as it did in the last couple of quarters, usually your model shouldn't really change much. But you will see price targets change. It's just because, well, price drives sentiment. Now, talking about price target changes, we have one here from Piper Sandler. So an analyst there has lowered the firm's price target on SoFi to $7.50 from $8.50 and keeps an overweight rating on the shares. He says consumer lenders have been under pressure most of 2022 due to the market increasingly pricing in a recession and higher unemployment. However, the sector has seen a near-term bounce due to the slowing inflation and the market pricing in less aggressive monetary tightening from the Fed, while the labor market has been incredibly resilient. He believes a reversion to pre-pandemic loss rate combined with net interest margin or NIM headwinds from rising deposit betas will keep a lid on forward earnings estimates despite near-term trends. Now, when it comes to guidance for the full year 2022, this is the one they gave us last quarter. So annual growth between 50 and 51%, great, right? Adjusted EBITDA, positive and quite a lot, between 115 and $120 million with an adjusted EBITDA margin of 8%. Now, the thing with that is that, well, it took something into consideration, which if we go to the earnings call, we can see exactly what. So their outlook also assumes a late Q4 2022 benefit in student loan origination ahead of the January 2023 federal student loan payment moratorium expiration based on the trend that we experienced in 2021. This benefit is expected to partially offset seasonal Q4 softness we typically see in other lending products. Well, obviously, things have changed. Now, during that call, Anthony Noto also said something about the annual percentage yield. So he says here that we did announce yesterday that we're moving to savings rate to 3% on annual percentage yield. and will continue to be nimble in the marketplace and ensure that we're in the top tier of value that we're adding to make sure we continue to get these high quality deposits. Now, this is 3%. Right now, you can get up to 3.75%. So if you're one of those customers, do check this out because, well, they just upped it again. And this is clearly something that you cannot find elsewhere. I know some of you might mention, oh, but Robinhood offers 4% or so. That is true, but with Robinhood, I believe you need to pay a yearly subscription fee of $60 or so. So you can maybe not find anything else that doesn't have any fees. And now let's look at the profit section of SoFi. So we're here in their Q3 earnings report. So net loss for that quarter, you can see here, $74.2 million. Now, share-based expense, which, let's be honest, of course it's an expense. Of course it's something to take into consideration, but it doesn't really show if a business is doing well or not well, right? So if you remove this, and that's 77.8 million, which of course is a lot, but if you remove this, you're suddenly positive profit of 3 million. I mean, not bad. Then if you look at depreciation and amortization, of course, this is now at $40 million. We don't know how much of that can be taken off. So let's be conservative, let's say 50%, right? 20 million of that can be taken away, let's say. Of course, you cannot really take it away because, well, in the financial report, you have to write it all down. But to look at how the business itself is actually doing, let's take 50% of that. You're left with 20. We're already at positive 3. So we're now at positive a profit of $23 million. That's a completely different story, right? Now, of course, I know, we've just tweaked the numbers here and there to achieve a hypothetical profitable business. For sure, I would love it if they were profitable without me having to take away share-based compensation and take 50% of the depreciation and amortization. Fine. But technically speaking, you can do this and look at the core business and see, they are maybe now turning a profit deep down. And even if you don't want to, well, tweak those numbers, just look at the adjusted EBITDA one. Last year, 10.2 million. This year, 44.2 million. So quite an improvement. So to conclude, and I'll have to say this, I don't know when the market will realize that SoFi at $4 to $5 is a bit weird. Of course, some people will say you have to value it as a traditional bank. In my opinion, I don't think that's the correct way to value this business. But hey, let's wait and see. Currently, 2023 does look like a year that SoFi will continue to execute quite well. Let's hope that in the back half of the year, the headwind will turn into a tailwind and suddenly the market will realize how strong the core business actually is. Of course, do share your thoughts down in the comments below, and if you enjoy this type of videos, leave it a thumbs up and subscribe if you have not, and I'll see you all in the next one. Bye bye.